The delinquent taxpayer is a member of the Calvary Temple Church in East Point, Georgia. Calvary is a functioning church with some 300 members, regular services, and a thriving evangelical ministry. The church has roughly 20 religious orders, which it describes as integrated auxiliaries of the church. Each order consists simply of the members of one family. To join, or in effect to become orders, church members execute vows of poverty, ostensibly conveying their property and future income to their orders. Theoretically, the church controls the disposition of this property and income. In practice, as the tax court found, the church members administer their own financial affairs as before. The fiction of church control is maintained through a system of allowances for which the members of the order apply to the church. The allowance, which is always granted, roughly equals the wage earner's income. Most members of these orders work for private or government employers. A few work for the Calvary Church. Some of the individuals in the instant suit filed tax returns claiming exemption from personal income taxes because of their membership in these orders. Many of these returns contained no financial information and were accompanied by tax protest literature. Some other church members filed returns claiming that any income for which they were chargeable was offset by deductible contributions to Calvary Church in the amount of their annual incomes. The commissioner of the IRS determined that each of these taxpayers owed back taxes. The IRS also assessed certain additions to these taxes for negligence, failure to file valid returns, and failure to pay estimated taxes. The taxpayers petitioned the tax court for redetermination of their liabilities. In a carefully reasoned opinion, the tax court denied the balance of the church members' claims. Those church members appealed certain issues to this court. The first question presented on appeal is whether appellants' incomes are taxable. We hold that they are. The tax court properly rejected appellants' claim that this income they assigned to their religious orders pursuant to vows of poverty was income to the religious body, not the members. This argument has been repeatedly disapproved where the court has found no agent-principal relationship between the order and the member. See, for example, Fogarty versus United States, 780 F. 2nd, 1005, Federal Circuit, 1986. Moan versus Commissioner, 774 F. 2nd, 570, 2nd Circuit, 1985. Stevenson versus Commissioner, 748 F. 2nd, 331, 6th Circuit, 1984. Where there is an agent-principal relationship, it is a basic rule of tax law that an assignment by a taxpayer of compensation for services to another person is ineffective to relieve the taxpayer of federal income tax liability on such compensation, regardless of the motivation behind the assignment. The Second Circuit recently explained the agency rule further. To prove assignment of income on an agency theory, the taxpayers bear a double burden. They must show that a contractual relationship existed between their secular employers and their religious order, and that the religious order controlled or restricted the taxpayer's use of the money purportedly turned over to the order. Here, the tax court found that appellation continued to handle their financial affairs in the same manner before and after their vows of poverty. The church had nothing to do with where church members worked and appellants took home checks in their own names.
That's good.
So read some.